Welcome back, everybody. What we're going to be looking at today is we're going to be looking at how variable costing affects our income statement. So to start with, let's talk about the costing that we've been doing so far, the income statements we've been doing so far. The income statements that we've been looking at so far are actually called absorption costing income statements. And what that means is all of the costs are getting absorbed into the cost of goods sold number. So the item that we're selling, the product that we're making, has not only variable costs in it, but it also has fixed costs in it. And if you remember the difference here, fixed costs are things like the property tax expense on the building, the wages of the supervisor of the building, things of that nature. Things that have absolutely nothing to do with the product itself and are fixed costs and have nothing to do with how many of a certain product you're making, whether you make one product or you make 1,000 products, those costs don't change. Well, under absorption-based costing, all of those costs get added together, the variable costs as well as the fixed costs, to become part of the cost of goods sold number. Right? Well, under direct costing, which is also referred to as variable costing, we're going to look at what the income statement looks like if we don't include those fixed costs. We're only going to include those costs that are variable, that change based on the number of items that you're making. So, things like direct materials. Direct materials are certainly going to increase if you make more of a product. Your labor is going to increase if you make more of a product. And variable factory overhead, things like electricity and such, are going to increase the more you use it, the more products you make. So with that, we take all of those costs, of those fixed costs that really don't have anything to do with the product, and we strip them out, basically. We don't include them when we're trying to decide whether or not a product is making us money or not. Oh, hang on a second. This is just a nice little graphic that illustrates what I was just talking about. You can see all of the direct materials, labor, variable, and fixed factory overhead are being included in absorption-based costing and are all part of cost of goods manufactured. Whereas under variable costing, we're going to be looking at direct materials, direct labor, and variable factory overhead. If we have any fixed factory overhead, like property taxes and such, then we're going to just look at them as an expense of the period, and they're just going to be an expense in our income statement. They are not going to be included in our cost of goods manufactured. So let's look at an example to see how this works. So here we have this company, Belling Company, that manufactures 15,000 units of whatever it is that we're making at the following costs. You've got manufacturing costs, you've got variable and fixed manufacturing costs, and you also have selling and administrative expenses. You have both variable and fixed selling and administrative expenses. Okay, and here's where you have making 15,000 units and the cost per unit. You've got $25 of variable costs and $10 fixed costs. The whole product itself is costing you $35 if you're using absorption-based costing. So this is typically what you're used to seeing here with that. You had sales of $15,000 at $50 a piece, right? The sales figure is not going to change. $750,000. Your cost of goods sold is at $25 of fixed, and your $15. Wait, no, I'm using the wrong numbers, but hang on, what were the numbers? The numbers were $25 and $10. There you go, from right here. $25 and $10, so it's $35 for the cost of goods sold, gives you gross profit, minus any selling and administrative expenses, gives you income from operations, okay? So this is your basic absorption-based costing income statement, what you've been looking at pretty much since the beginning of financial accounting. Now under variable costing, we're going to look at it a little bit differently. You're going to notice that our income from operations is going to stay the same. Because all we're really going to do is we're going to recategorize what we have here. We're going to look at it from a slightly different perspective. So here we go. Here's a variable costing income statement. What we're looking at here now is we still have the same sales figure. That didn't change. We sold 15,000 units at $50 a piece. But what is going to change is how we're going to look at this. We're going to take out our variable costs first, and then we're going to take out our fixed costs afterward. Alright, so our variable cost of goods sold was $25 a unit. That's $375,000. We have a new title here. We've got something called a manufacturing margin. So really what we're saying this manufacturing margin is telling us is we're saying how much is it really costing to make this product. It's very similar to the contribution margin concept, but not quite there yet. right? The manufacturing margin is saying we're selling these things for $750,000, and really they're truly costing it, the cost of the product all by itself, the actual direct materials, direct labor, and kind of variable factory overhead. Those are the costs to comprise as $25 a unit. In total, $375,000. So we're really making $375,000 on the sale of this product, right? Then from there you can subtract variable selling and administrative expenses. Again, it's a variable cost. So to come up with contribution margin, it is sales minus all variable costs. Gives you contribution margin. You learned this in the last chapter. All right, so here you go. Your contribution margin, if you pull selling and administrative cost, how much did it cost you to actually make and sell the product? It cost you, well, $750,000 of income, less $375,000, less another $75,000 to make the product, so $450,000 to make and sell the product. You really made $300,000 on this product overall. Now let's take out those fixed costs. Fixed manufacturing costs, again, things you have no control over. And fixed selling and administrative expenses, same idea. And that's something you really have no control over. And maybe even if you do have control over it, it has nothing to do with the product itself. Right? The product itself is making money. The product itself is making $300,000. So after you pull out all of those fixed costs, your income from operations is the same as it was under absorption-based costing of $100,000. The difference here is that you're really able to look at how the product itself is doing, whereas under the absorption-based method, that information just simply isn't available. As far as you know, you just made $100,000. Your product had gross profit of $225,000. You really don't have a good sense of how much the product itself is making. All right, we're going to look at yet another example of why variable costing is a much more efficient tool to use for managerial accounting. So here's the example of the problem we're looking at. Fran Manufacturing has no beginning inventory. Sales are estimated to be 20,000 units at $75 a unit, regardless of how many we're making. Okay, so we have two proposals here, Proposal 1 and Proposal 2. Under Proposal 1, we're going to make 20,000 units of whatever we're making, and we're going to sell all 20,000 units. And we're given the costs here. $35 worth of variable cost, $20 worth of fixed cost. We're making and selling 20,000 of these units. And again, here's our selling and administrative costs. And under Proposal 2, what we're going to do is we're going to make 25,000 units, but we're only going to sell 20,000 of them. It's going to leave us with 5,000 that are still going to be sitting in our inventory at the end of the year. Okay, so under absorption-based costing, what's going to happen here is we have our sales. We have these. Here's our Proposal 1 and here's our Proposal 2. This one we're going to make and sell 20,000 units. Okay, so if we make and sell 20,000 units, it's $35 in variable cost, $20 in fixed costs. Here we have our sales minus our cost of goods sold, gives us $1.1 million. We have gross profit of $400,000 and our selling and administrative is $200,000. Our income from operations is $200,000. Now if we look at the 25,000, we made 25,000 but we only sold 20,000. So our sales figure didn't change. But what is going to change is our cost of goods sold number is going to change. If you look here, our cost of goods sold number is $1,020,000. Now step back for a second here. What's the problem? The problem is that we still sold 20,000 units. That didn't change. So why should these numbers be any different? Why we only, even though we made 25,000 in Proposal 2 here, we still sold the same 20,000. So why is our cost of goods sold number lower in this scenario? All right, now we get all the way down to income from operations. It looks like we made more money, when in reality we sold exactly the same number of product. It's a little concerning, isn't it? Alright, so what's happening here is, if you remember from the last chapter, the more you spread fixed costs, if you spread fixed costs over more units, then it's a lower cost per unit. Alright, so what's happening here is we are making, in the first one, we're making and selling all 20,000 units. Alright, no problem. Nothing's left over. But over here we're making 25,000 units. So those fixed costs, they really have nothing to do with the product themselves, but those fixed costs are included both in cost of goods manufactured and in the ending inventory that is still sitting on our shelves that have not been sold yet. So our fixed costs are getting sold over a greater number of units. So when it looks like we're selling 20,000 units and our costs should all be included in those 20,000 units, they're not. They're being included in 25,000 units. Fixed cost is being spread over more units, making it appear that our cost of goods manufactured number is lower, making our net income look higher. This is very concerning. We're still buying, not buying, but we're still selling exactly the same number of units. It's very strange, if you will. It's skewed that, whoops, I'm moving stuff around here. It's skewed that we have $280,000 of income when we sold exactly the same items in both scenarios. Okay, so under absorption-based costing, this is rather misleading.